Hey, Paul Mauro, Smart Financial, welcome back. Thanks for subscribing. Follow us on this channel. Make sure that you stay to the end so you can email us, get a copy of one of my first two books, which is Smart Financial Grandparenting and Smart Financial Longevity. And then if you're really patient, come June, is number 3, which is Smart Financial Wealth Building. The trilogy will be done for 3 generations, millennials, boomers, and the great X-Geners. Okay, let's talk about the topic today, which is stop buying insurance. Holy cow, I can't believe how much money people are paying on insurance when they don't have to. So let's help you solve this problem and get more affluent by being smart about your insurance purchases. So let's just talk about the consolidation of the insurance industry, the consolidation of products, and why you don't need to be paying for insurance bills, okay? The industry has evolved, and let's be realistic. None of us own many things that we bought 30 years ago. Whether it's a car, an air conditioner, sometimes even a house, whatever. Products change, people change. There's a product revolution. There's a big one that's been going on in the financial industry. It has impacted the cost of things. Technology, the collision of technology in the money business has resulted in lower costs for, ETFs, stocks, bonds, insurance. Everything is going down in cost. AI is going to make it even cheaper. And the reason is, when I first went to a meeting as a young advisor many years ago, I went to a meeting at Dorothy Quincy Suite in Boston where Fidelity is organized. They had a big thing going on. A very famous guy was there, Peter Lynch, who ran a fund called Magellan. And we were all concerned at the time. I think that mutual fund cost like 3% load and 3% a year to buy it. But there was about 60 people on his team. They were traders and they were analysts and all that. Now I think it's 2 people and a dog. And it's really different. The technology has reduced the number of people that work in these areas, whether it's the actuarial department of insurance or the analytical department of a fund company, et cetera. So less humans, less overhead, not great for the whole employment story. We can talk about that at another time, but we used to say microchips are eating jobs. Now it's AI and robots are eating jobs. So let's talk about what that means to you as an insurance buyer. So years ago, we would go out, we would buy a policy called a life insurance policy. We would buy another policy called a disability policy. We would buy another policy called a long-term care policy. And then we would buy some other kind of a policy or product called a retirement policy, okay? So we're paying into 4 different types of financial products. And a lot of them were insurance products at that time. Okay, forget all that. Let's just fast forward to 2025. Here we are. And what has happened to the industry? Now, in 2025, you can consolidate these into one product. The one product is actually cheaper than the 4 products put together, dramatically by a half. That means you can cut your insurance cost in half. And let me tell you why. Everybody in the insurance industry got a lot smarter. The computers got smarter, the data got smarter. And they figured out, guess what? People who are getting older are going to either get sick or they're going to die, and there's no getting out of it. So what they did is they bolted on to life insurance, long-term care, and nursing care benefits. What does it really mean? In a perfect example, I did this for myself. I will tell you, I wouldn't suggest it to anybody if I didn't do it myself. Instead of having $1 million death-only insurance policy, now I have a $1 million policy that pays for death, or $1 million if I go into a long-term care facility. And I don't have to pay a bill for the life insurance and a bill for a long-term care policy. Now, also what happened is long-term and nursing care has become a huge problem in America. Now, I don't care how much money you have. If you want to do smart leverage, you want to use an insurance company to pay the bill. We call it OPM, other people's money, right? Rather than paying $1 million in nursing care in cash. So if I can basically give an insurance company $300,000 and they pay my long-term care company $1 million, that's leverage. And I can give them $300,000 and they pay my family if I die $1 million on the same policy, it's double leverage. So, number 1, life insurance policies today also pay long-term care. Number 2, life insurance policies today also pay lifetime income. They look like retirement plans. They are convertible to retirement plans. They're convertible to lifetime income plans. In fact, what's great about it is life insurance policies through all the changes of the last 25 years, and there's been huge changes, have not lost their tax preference category. This is huge. So what do I mean by that? Every dollar you put into a life insurance product accumulates on a tax-deferred basis. That's number one. Number two, life insurance dividends are tax-exempt income. They are technically a return of premium. So a life insurance policy grows tax-deferred, any dividends are tax-free. This is hot, right? The third thing is that if you've paid $300,000 into a life insurance and then you die and it pays $1 million to your family, that extra $700,000 is income tax-free. It's like buying a stock and all the gains are exempt, okay? This is sizzling hot. So you have the tax exemption, the tax deferral, the tax-free benefit. So life insurance has replaced a lot of other products that we don't have to pay for anymore. So very typically today, if someone has already maxed out on their 401k, you put in as much as you can. You're not self-employed. You can't go out and do your own SEP or other retirement plan. And you're looking for a place to stuff money where you can get tax-deferred growth and tax-free income on the other end. It's insurance. Life insurance has become the replacement for a municipal bond. And let me tell you why. When you're paying into a municipal bond, you have a significant amount of principal risk. That means you could lose your money. Okay, a bond is a security. What does it mean? If your bond is a 5% bond and the interest rates go up to 6%, your bond is no longer worth 100 grand you paid for it, it's worth 90 grand. Interest rates go up, your principal goes down. This is not true with insurance products that have guaranteed principal built into the product. So insurance products are favorably treated if interest rates go up. Most of them even have a floor in them. And a lot of them, like the one I got for myself, I will just tell you, I'm very happy with the products. I actually got one for my wife, Linda, and one for myself, and we modernized our insurance. Our insurance now has cash in it, and that cash is guaranteed, and the interest rate is tied to a couple of indexes that we like. Linda likes the Dow Jones. I like the S&P. Well, guess what? If the Dow goes up, Linda makes money. If the Dow goes down, she doesn't lose anything. In mine, it's the S&P. If the S&P goes up, I make money. If the S&P goes down, I don't lose any money. So it's a win-only proposition. And those policies for our children are guaranteed death benefit policies. But, you know, in my circumstance, both my parents ended up in long-term nursing care. And they went through a very substantial amount of money. My father was a Sicilian immigrant. He came here with nothing. He had a successful run, bought a beautiful home in Connecticut, built a business, had some money, and everything was great until they tragically had some health issues late in life. They ended up in 4 different nursing homes, lots of expense. Luckily, my dad accumulated a lot of money and he paid for it in cash. That's not the smartest approach. That was his sort of Sicilian immigrant approach. If it was a $1,000 expense, he rolled off $1,000 worth of hundreds, right? So my father did not use leverage. So I love my father. He was great at a lot of things, but this product did not exist for him. This was like him trying to make a cell phone call before cell phones were invented. It wasn't there. Now we have a different story, okay? I am basically my father, getting to be that age, and I'm thinking if I need $1 million of long-term care, I'd much rather get away with just paying $300,000 to an insurance company and use OPM, other people's money, okay? All right, this is a very, very big sort of solution to a very big problem, right? And it solves the problem of paying too much insurance premiums. I would say if you have insurance policies and you've had them for years, I will be willing to bet. In fact, if you email me about them, I'd be willing to bet they're completely out of date. They're something like your grandma's refrigerator she bought from GE 50 years ago, whatever. I mean, it's great when you got them, not so great now. Also, I think in the modernization of products and the lower cost of products, it's remarkable that some of the fantasies that we were told when we were younger, that, oh God, you can never buy insurance over 60 because it's outrageously priced. I mean, these things just aren't true anymore. Why? In my book on longevity, right, we explain the fact that these tables have changed. They used to sell insurance policies with the idea that people were going to be dead in their 80s and they better get a lot of their money quick before they got older. Now, people are living out 20 more years and there's 20 more years to collect premium, so the premium collection is less. So this is just the evolution of life expectancy, actuarial planning, and mortality tables. It's a good thing, folks, by the way. It's a really good thing. This is something that's been modernized to our benefit. So let's stop buying for excess insurance policies that we don't need and get a modern insurance policy that pays. A lot of mine has critical illness coverage. If I get cancer or I have some other sort of critical illness, it pays money. If I die, it pays money. If I go to a nursing home, it pays money. I mean, these are like the Swiss Army knives of financial products. And you can't invest your way out of some of these things. Investing is great, but insurance is one of the pillars of doing financial planning. If you get with a firm, a true financial planning firm, and you read chapter 14 in the book or chapter 7 in my grandparenting book on how to hire a financial advice firm, if all they talk about is investing, you should get a different firm, because financial planning and wealth management is risk, investment, tax, cash flow, and estate planning. 5 pillars to hold this thing up. First one is risk. What is risk? Risk is insurance coverages, right? Risk, investment, yeah, that's nice. Investment's number 2, right? Risk, investment, taxes, cash flow, and estate planning. Okay, so don't pay for, one service when you can get 5, right? Get the right financial firm that's doing all 5. Get the right financial product that covers 4 things, right? Let's try to save you some money, right? Let's solve the problem of overpaying by stop paying for insurance that you can replace for less cost. So I'm Paul Mauro, and this is Smart Financial. And just doing an analysis of your insurance products, bringing them up to date to 2025, meeting with and taking the advice of a complete wealth management firm, as I'm suggesting, these things are just the art of being smart.